Thanks very much. So I come from the capital raising side of things. 20 people, 3 offices. I would say, I've got things I want to get across. Just 10 common mistakes in capital raising, and then what I call the transformation of being, because it particularly relates to this audience. So I would start by saying that the hedge fund industry is a continually offered vehicle. So hedge fund marketers are always marketing. Like, we're going deeper, we're constantly marketing, we're trying to find sovereign wealth funds, endowments, family offices, fund of funds, consultants, private banks, and there's a network within the community. So relative to the tech community, which is frankly pretty episodic and is frankly, in my view, very West Coast based. So of the people I hear that are being approached, it's the usual VC funds that's largely comprised in whatever Silicon Valley geographically in general, and being approached by startups and companies of all sizes. Like, relative to hedge fund marketing, it's a relatively loose approach. Like, in the hedge fund industry, and there are about 10,000 hedge funds, you're approaching the biggest and best for, if you're what we call an asset gatherer, a multi-billion-dollar, $20 billion fund. Like, it makes no sense to approach a small opportunistic family. And if you're what we call a performance-driven manager, maybe you've got 50 million under management, maybe you've got 3-year record, you're going to approach more the performance-driven fund of funds or consultants or private banks, or you might do a structured product or things like that. So in capital raising, I would say there's, as I see it, a structural divide between the episodic-minded sort of capital raisers, the platforms and such, and how we see it on the hedge fund side. But my point is, philosophically, the two worlds should meet. The fintech, let's say Silicon Valley, Palo Alto-based community, needs to come to New York, Chicago, London, Paris, Geneva, Brazil, South Africa, Italy, Australia. There's a bunch of dedicated investors with absolute return sort of buckets that I think go unapproached. Even in New York, I'll be chatting with a pretty sophisticated marketing sort of fintech platform, and I'll say, "Oh, did you speak to this group and that group and that group?" And they'll say, "No. Who's the Michael Dell family office? Like, who are they? Like, it's called MSD Capital. Like, well, did you talk to Peter Thiel's group? Yeah, we did. Well, you're not talking to the right guy. Did you talk to the Jenny Craig family? No, we don't even know the Coopers. How did you find them?" And those names, Sealy Posturepedic, Nathan's Hot Dog, Kind, Snack Bar, those are all very commonly approached, potential investors in the hedge fund community. So I would just say that there's a world and there's a number of options that you can scale into. Now, before I get into, so the second thing I want to talk about is what I call the transformation of being. And I mentioned it because of some of the other speeches. But basically, what I'd say is what the world is missing is that the human being is an obsolete concept, right? So I've transformed my very being philosophically because if you look at the top down and the bottom up, they started, and one of the earlier speakers were talking about it, which is why I bring it up. We started as hunter-gatherers in what we call the Stone Age. Then they put us in the fields, and we were basically farmers in the agricultural age. Then they put us in the factories, and then that was basically the industrial age. And then they put us in the cubicles, and that was the basic corporate age. Except now we are in the information age. And the information age is a world of possibility, right? And in the world of possibility, the human being that is full of fear, that's full of judgments, that are full of binary events, that is just hardwired to think about being attacked by a saber-toothed tiger or something like that, is an obsolete concept. In the information age, what I really am, and why the hedge fund guys have the most planes, have the biggest beach houses, have the biggest art collections, at least as it relates to Midtown Manhattan. And you can just Google hedge fund billionaire and see the list come up. Top hedge fund earners make $4 billion, $1 billion, $3 billion a year. Not that there aren't successful fintech entrepreneurs as well, but as a group, if you Googled hedge fund billionaires, the list is long. And I just differentiate that from the Wall Street, which is different. It's not the hedge fund industry. We feel like it's separate. But the reason why it's relevant is I think we are all information processing and monetization beings in the information age. What a hedge fund basically is you take information, you process it, and you monetize it. And there's no reason why in the information age we cannot ourselves be information processing and monetization beings. And you as a community would relate to it much more than, because sometimes I do this speech and people think I'm crazy. But We are all basically in the business, in the information age, in a world of possibility, of trying to understand information, processing it in our own way, and monetizing it. To a hedge fund manager who's an information addict, the real game changer is being told something that he didn't know that he didn't know he didn't know, right? Or to be told something that he thought he knew that he didn't know he didn't know. Because we all know what we know, right? And we all know what we don't know. And we can all figure out what we know we don't know by going on the web or asking, right? But how many people in this world have the world of information at their fingertips? They can ask the web any question it wants, yet they don't for no apparent reason. And that's the human being, right? Very limited in scope, very limited in their mentality. And that's why I think in the information age, it's all about information processing monetization. And the way to liberate yourself is to simply redefine your very being. Monetization could be health, it could be wealth, it could be happiness. It doesn't have to be money. The better term for it is probably information processing and self-actualization being. Because when you think of it, life is really about self-actualization, maybe being one with a higher spirit of oneself. Everyone's got their own definition of self-actualization, but that's really what the world of possibility is in the information age. It's information process and based self-actualization, however you define it. So just a thought that when I'm saying these things, I'm not trying to be aggressive. I'm not trying to be rude. I'm just trying to find that data point for you that you didn't know, you didn't know, you didn't know. And that's why I like when people talk to me, because I see all these, you're being told something you know you didn't know, but that's okay. It fills in what you know you didn't know. But I really want, what really gets me excited as an information addict is being told something I didn't know, I didn't know, I didn't know, right? So just for what it's worth. And the last part is, redefining your very being is superior to what you see in the general marketplace, which I call the basic playbook of chicken soup or positivity or some person's individual highlight reel. Like, this is my story and now I'm successful, or you can never quit. You got to give 110%. So those things you see out there fulfill desires. They don't fulfill needs. They don't actually help you self-actualize. They get you kind of there. In my view, is it's like a soda or a candy bar or something. It gets you there, but it doesn't basically put you on the right structural path. So when you see the other people talking out there about, their approach and how they never quit and you got to give 110% and here's some chicken soup and validation and, oh, by the way, here's a highlight reel of my story when I started out here, and, it's just the same basic playbook to me. Whereas just gently redefining yourself as information processing and self-actualization, or information processing and monetization being, you're on a different track, and you'll scale into those verticals as specifically or as philosophically as you like. And that's the beauty of transformation. And the way I got it was going to these events. Everyone would talk about disruptive technologies and transformative technologies, and I was like, yeah, whatever, blah, blah, blah. But there is some truly jaw-dropping things. And then being a hedge fund guy, I related to the top down and the bottom up, and then it kind of triangulated into the human being is just an obsolete concept. Anyway, so on 10 capital raising mistakes, going to try to stay on time. So everyone in the hedge fund space strives for what they call the one and done career year. And I think you have that in the fintech space as well. In striving for the one and done career year, you should raise the money any way you can, right? And I see it in the hedge fund space and then in the fintech world. People are specific. They only want to raise it from families. They only want to raise it on certain terms. They only want to raise it at certain times of their business. They only want to raise it, if the investor has some strategic value. There's so many, like, what I call human being sort of black and white thinking on when to raise money. It's a spectrum as an information processing monetization being. You want to constantly be marketing. I can't tell you how many companies I see or how many funds I see where their business is hanging by a thread because they didn't raise money or they weren't constantly putting coals in the fire. The easiest thing to do is to raise as much money as you can, any way you can. You can always push it back. You can always refuse it, but keep marketing, because I can't tell you how many times I'll run into a group and they'll say, well, we're not really raising capital, or, oh, well, we're comfortable with our burn rate, or in the hedge fund space, oh, we're focusing on performance. Like, it's a blend. It's not yes or no. It's not black or white. We are or we're not. It's not episodic. Just keep raising it any way you can. Get that one and done career year under your belt, and then you can decide philosophically what you want to do at what time. But the baby step approach, or the binary sort of black and white approach to capital raising, it always strikes me as not being as high percentage an approach as it could be. Which one? there's capital raising, there's cap intro, and there's writing a ticket and securing an allocation. Capital raising to me it's 3 to 7 meetings. It's 20 points of contact. It could take 3 to 20 months. So to think that you'll have a dinner with an institutional investor or family and just get a check in the mail is not, at least the market we cover. There's diligence and there's a learning curve, and so you might as well just assume 3 to 5 to 7 meetings before an allocation, and there's ways of tightening that up. The second thing is on launches. No one really, the tech folks are better about it, but nobody really seems to reverse engineer a product. So what you want to do is kind of survey the landscape and then figure out where you have a niche and an edge and reverse that, engineer that, test market that, and tighten that up. So someone was saying earlier that 100% of the companies they've invested in have morphed over time. That just tells me you didn't do the homework when you launched. Not that I'm being negative, not that you can't morph over time, because the only way you know you'll be successful is if the market tells you, if the investors tell you, if your financials tell you. Because I think there's some in technology, and I'm not being negative, and they're in the hedge fund space too. They do it for fulfillment, or they do it for disruption, or they do it for fame. In the hedge fund space, we get paid an incentive fee. The only way you know you're successful is at year end, you get 20% of your profits. And you could get there with 1 day of trading. You can get there with one position. You can get there throughout the year. You can get there on the last day. Like, it just doesn't matter. In the hedge fund space, we judge by external circumstances. You're paid 20% of your performance. You might have gotten there working 150 hours a week. You might have gotten there working 20 hours a week. Like, in the hedge fund space, no one judges. It's just you're getting 20% of your performance. So I'd say reverse engineer something that'll sell. Give yourself the flexibility to morph, to let the market tell you what it wants or doesn't want. But that's something I don't see. A the Q, A the Q, A the Q, A the Q. You're going to be asked a question. Answer the question. I can't tell you how many times I get some sort of what I call topic switcheroo, or some sort of dumb disclaimer, or something. Like, we're all in the business of putting money to work. Put your best foot forward. Answer the questions directly, and then back into the story. No one thinks you're rude, or no one thinks you're aggressive. They're just trying to do as much as they can to talk shop with you and find a place to work together. Not that they're biased toward working to you, but their whole job, at least in the hedge fund space, they're subject to process. They have to meet with 20 managers a month. They have to bring to committee 5 ideas a month. That doesn't mean they fund them, but they sell those processes to their investors. So the more you can make their job easier by cutting to the chase, telling them what you do, giving them a due diligence packet, giving them a proper presentation or an offering memorandum or whatever it is that you can help them, the more they're inclined to try to work with you. And I'm not saying it's easy, but I do think, to my earlier point, the fintech community has to meet the New York City community, or what I call the absolute return hedge fund community, because they're going to be your quickest sources of capital. I'm not saying it's the friendliest sources of capital. I'm not saying it's the most, the best terms of capital, but it'll be the quickest, because that's what the hedge fund industry prides itself on, and the family office industry. They understand the clock is ticking. They understand their edge is to respond quickly. And so if you take a deal to a hedge fund or a hedge fund family office or a family office in New York City, if they really want to move forward, they understand they can extract better terms by the quicker they move, as opposed to, I hate to say it, but some institutional Silicon Valley investors, where they'll look at whatever, hundreds of deals a year, maybe fund 1 or 2 a quarter, and then babysit them for a longer period of time. The investment style is just different. And I'm not saying it's better, I'm just saying it's different. And I do think the hedge funds and families that give you money are going to be biased toward helping you. They're going to want to monetize that investment with something like a 1 to 2 year time frame, just because that's how they're judged. And then I want to be careful of time. Yeah. So, in general, there's what I call, the alpha and beta products. You've got 3 different return profiles in the hedge fund industry. You've got absolute return, typically more volatile than the market, but superior to the market. You've got superior risk-adjusted returns, right, which are lower volatility in the market, but lesser returns. And then you've got low correlation returns, What they want from, I think, this community is a combination of low correlation returns and high absolute returns. That is, they don't want superior risk-adjusted returns. So they need your investments to pop at a time that's highly low correlation or highly non-correlated to the broader markets. And they need you to do well. So if there's any way of, from a free cash flow basis or a daily income basis or an operating capital basis, of structuring your return profile so that it moves independent of the stock market, that's going to be of huge value to them. And then, of course, you've got to do better than the market because it's a longer-term lockup type vehicle. A lot of the hedge fund managers are putting money in their funds into the fintech community, particularly in alternative lending, which is red hot because it's a perfect natural for the hedge fund community. Every TMT or healthcare fund typically has something in its offering memorandum that allows it to do 10 to 20 or 30% of their investments in the fund in illiquids or privates. It's a terrific source of non-public information for hedge fund managers in a space where information is getting commoditized. So they'll give you money, but they may want to bug you about your contacts, what you're seeing in the marketplace, your competitors, like additional sort of ideas or contacts you can make from them. And you're a private company, so they can go much deeper. And they're also going to want to actualize value. If you Google some of the hedge fund blogs and you Google TMT private investments, you'll start to see some of the names. And it's been a successful strategy for a number of folks. So, that's pretty much it. Just to keep us on time. Okay.
Victor, just wanted for the audience that don't know about your organization, you do annual event in Las Vegas. We were grateful to be there last week, and also could you just elaborate on that? When it's going to be?
Yeah, thank you. So we're 20-person, 3-office hedge fund capital raising firm. Our top down is our events. We specialize in speed dating. To that point of you can get to know someone pretty quickly in 15 to 30 minutes if there's going to be a chance of allocating. I co-founded the SALT conference with Anthony Scaramucci. Anthony keynoted our event last week in Vegas, where we're trying to triangulate the hedge fund investment community, hedge fund managers, family offices, with the fintech community. It's another philosophical thing, but kind of having Anthony there, and Anthony was really very interesting. There's, you hear fake news coming out of Washington, and someone goes, well, there's real news. And you never know who to believe because, of course, the real news guy is going to say his real news is real news, and the fake news guy is fake news. And all we stand for really is a different truth. So I just think it's a perfect example of there's a spectrum, and there's so much information, it's so much to process that there's just a sliver that's a different truth, and it doesn't make it right, it doesn't make it wrong. It's just, for what it's worth, a different truth. So Sydney will be active with us in May at SALT. We want to bring the fintech community to our SALT community. If you haven't seen it, you should go to saltconference.com. We've got Bill Clinton, Sarah Palin, George Bush, like Sharozovsky, Kobe Bryant, Al Pacino, Will Smith. They've all spoken at SALT. It's about 1,500 people. I think it's the highest quality event in the hedge fund industry, and it's a natural to bring the fintech community to it as well, because the two communities would get along, and there's a very natural fit for both communities to meet and speed date with each other.
Thank you very much.
Okay, thank you.